We've looked at the bits and pieces. We've looked at how to calculate tax. We've looked at the difference between tax credits and deductions. Let's do an example with the full tax process, so all 5 steps. So in this example, we have 2 people, Abishola and Sanjay. They have 1 child and they file under married filing jointly status. That means they're married and they're filing a single tax form together. Abishola had $50,500 in income from wages, and Sanjay had $45,000 in income from wages. Together, they had $1,540 of taxable income or interest. During the year, they made $5,000 in contribution to a tax-deferred IRA. Their itemized deductions were $26,200. Let's go ahead and calculate the tax they owe. And I've got the tax table for married filing jointly here on the page. I also have the standard deduction for married filing jointly, which is $25,900. So we'll use that information as we go along. The first step in the process, though, is to calculate gross income. Gross income means all of the income. So we need to take Abishola's income of $50,500. We need to take Sanjay's income of $45,000. And then we also need to take their taxable interest. So those are the incomes I see that we've been given. We've got their wages and their interest that they got taxed on. This is going to total up to gross income of $97,040. So that's the first step, is we work out and calculate the gross income. Now, sometimes we can make adjustments, and in fact, Sanjay and Abishola have made $5,000 in contributions to a tax-deferred IRA. Tax-deferred means they can reduce their gross income by $5,000 because they're not going to get taxed on it initially. So they take that gross income and we're going to subtract $5,000 from it. So their adjusted gross income is going to be $92,040. Next, we'll work out their taxable income. Now, taxable income is what we get after we take deductions. Okay, we're going to subtract deductions. Now, deductions can be done in one of 2 ways. We can itemize, and the itemized deductions that they've worked out are $26,200, or we can take the standard deduction. And the standard deduction is determined for you by the IRS. And I wrote it down here. It's $25,900. And you always want to take the bigger of the 2. The bigger of the 2 is better because it reduces your tax burden by more. It reduces your income by more. And in this case, the itemized deduction is more than the standard deduction. So we're going to subtract the itemized deduction from their adjusted gross income to work out how much they're going to get taxed on. So when we do this subtraction, we get $65,840. So this becomes their taxable interest. I should say taxable income. Sorry, they both start with IN. Taxable income. This is their taxable income. Now, we use their taxable income in the table to calculate their tax. So now we go to the table. Look for $65,000. Where would that be? Well, it looks like it's in the second tax bracket because $65,800 is between $20,551 and $83,550. So we will go across to the formula to the right of that in the table and see that to calculate the tax, we're going to take $2,055 and add 12% of the amount that they have in taxable income over $20,550. So remember, to get the amount over, you subtract their taxable income and that level, $20,550, to get how much they're charged at 12%. Doing that full calculation, I'm just going to use a scientific calculator and get it all at once. I get that they owe $7,489.80. That's the tax they owe, or the tax owed. So there were 4 steps we had in this process. We found the gross income, we adjusted it based on that contribution they made to a tax-deferred IRA, or contributions they made, and then we look at their itemized deductions as reducing their tax burden even further. So it reduces their income so that we get a taxable income. Once we have the taxable income, we can use the table to calculate the tax. Now we have one step left, but I didn't have room on this slide to show it. Let's do the next step. All right, we know that Abishola and Sanjay owe $7,489.80 in tax for year 2022. Well, let's get a little bit more information to do this last step. In July 2022, they purchased a new energy efficient furnace for which they get a tax credit of $100. Remember, what a tax credit does is it's going to reduce the tax you pay, and it reduces it directly. So I can directly take $100 off of what we owe, or I should say Abishola and Sanjay owe. They now owe $7,389.80. During the year, their employers withheld $7,600 from their paychecks for federal income tax. Do Abishola and Sanjay get a refund, or do they need to pay more? Well, this is the tax they owe, and they had $7,600 withheld. Now, withheld means it's already been paid by their employer. In other words, they've already paid it because it came out of their paychecks. So this is actually what's been paid. And so if you compare these two, they've actually paid more than they have actually owed for this year. Because they've paid more, that means they get a refund from the federal government. They get a refund because they paid too much. And to work out what the refund is, we just simply subtract those two numbers. So $7,600 subtract $73,89.80, and that comes out to $210.20 in refund. So they get a nice little refund, a little over $200 in refund.